Joining me now is Surevest Wealth Management CEO Robert Luna, along with Vision 4 Fund Vice President Heather Zumaraga. Thank you both for joining us. Rob, let me get to you first. I was looking at your notes. You say you're going to have to be more tactical in this environment. What do you mean?
Yeah, I think so, Ashley. I mean, when you look at the markets right now, it's kind of a bifurcated market. You have the Amazons and the Netflix that continue to hit new highs, but then you have some of these companies like your Verizons, AT&Ts, consumer staples that are trading at pretty high valuations. And if you do see these yields start to tick back up, those are going to become competition for those stocks. So the buy and hold and forget about it approach of easy money-making days, I think, are over. Investors need to be a little bit more tactical and thoughtful about where they're placing their capital in this market.
And talking about those bond yields, Heather, you know, Goldman Sachs out with this report saying, look, if that yield gets up to 4.5% by year end, the stocks could be hit by as much as 25%, down to 21.55 on the S&P. Now, that could be an outlier for sure, but how concerned are you about these yields really starting to take off?
I am concerned about the yields starting to take off over the short run, at least. And Goldman's estimate of 4.5%, I guess, would be the worst case scenario with markets declining 25% at that time. But it really gets to the heart of the issue that there may be a correlation between interest rates rising and the stock market going down. Look at today, for an example. We're rallying into the close, perhaps. The market's up over 300 points, and bond yields are down today, the lowest levels that we've seen in about 2 weeks, I think 3 weeks, 2.87 on the 10-year. That's telling me as bonds go down, as interest rates go down, the stock market is heading higher today because the price of bonds, the price of bonds is up, interest rates are down.
Exactly. Rob, let me get back to you. Ray Dalio, the big hedge fund guy, says, look, he believes we could very well be in a pre-bubble stage and says he sees a 70% chance of a recession by 2020. A little alarming. Do you agree with him?
Yeah, I don't know, Ashley. I mean, these grand prognostications have to be accompanied by action strategies. And,
right.
you know, not too long ago, Ray was saying to stay in the market and be fully invested. So, I don't know. I think when you look at the market today, I think there's areas of opportunity that investors can be in. And I think there are areas that are a bit riskier today, but that's not really very different from the past. So I think, again, you just have to be a little bit more selective. But sitting in cash for most investors is not an option waiting for this to occur.
Heather, how do you think the Fed plays this? We have a new head of the Fed, Jerome Powell. He seems to me pretty similar to Janet Yellen. I would imagine, even if they give perhaps some more hawkish, indications, they're not going to suddenly throw in a whole bunch of rate increases in a row. I feel like they're going to handle it with a little bit of caution, I would say. Do you agree?
Right. Yeah, you're right. I expect him to echo some of the comments from the report on Friday of the the Fed's policy report on Friday. I think that Jerome Powell will tread very carefully in terms of the pace at which he hikes rates. A quarter basis point, the markets have been shown to digest okay in the past. But look, he's expressed concern over market valuations and equity asset bubbles in the past. As the report on Friday from the Fed indicated, high valuations in the markets as well. So if they're going to let some air out of this so-called balloon in the equity markets, I think he's going to do it slowly. But Ashley, the markets, I don't know if they can take the Fed unwinding their balance sheet. That's going to happen in the second half of this year. And that will be a big test. We're on unprecedented territory in terms of even the European Central Bank is set to unwind their balance sheet in September. And that's never been done before in the history of our markets.
And that's a good point, Heather. Rob, what do you think about that? You know, there's so much cheap money, slow interest rates for so long around the world, for that matter. Can we get back to a normal world, a normal market, so to speak?
Well, I think we have to. But again, it's some of these areas, Ashley, that have been the bond proxy stocks in the market, which have become a larger part of the S&P that I'm really concerned about. When you're a company that's growing top line 2 to 3%, you're trading at 22 times forward earnings. That's not very sustainable. So I think there are a lot of areas to the market that are very vulnerable. And like Heather says, this is going to be a massive unwind. And the days, like I said, of easy money, cheap money, just throwing it out at the stock market, I think are over.
Yeah, the normal day. Heather, let me just follow up with you very quickly. I've noticed on the markets around 2:30 to 3 o'clock every day. That's when, if we're going to be volatile, it seems to kick in at that point. Have we gotten that out of the system yet, or do you think we're still in for a few roller coaster sessions as we move forward?
That must be because of you, Ashley. We'll see if you can move the markets in about 20, 25 minutes here. I think that the markets, if we can rally into the close today, this will be our second day of doing so. It's a transition from the past 2 weeks where we sell off into the close. So that will be very important, as is the final hour. But we'll see if you can move the markets here in 20 minutes.
All right, last one to you, Rob. You know, a lot of people have got cash on the sideline. Even Warren Buffett, he's got billions on the sideline. What advice, very quickly, do you give to those people who are a little, nervous about jumping in right now?
Well, he'd probably say buy more Apple stock, right? And I mean, I think there are companies like Apple that probably make sense for investors, right? These are great companies that have pulled back a little bit in this run. A company like Apple is one that has a great cash balance sheet, doesn't really have to worry about rising interest rates. So again, if you're going to get into the market, it's very, very difficult at time. Just be a little bit more selective. Stay away from those bond proxies and look for some of these big growers.
He's a billionaire. Of course he'll have a lot of cash on the sidelines. I'd like to as well.
And he doesn't pay enough tax, apparently.
Yeah, right.
Rob and Heather, thanks so much, guys. Really appreciate it.